Hey there, I'm George Kamel, Ramsey personality and financial expert. If talking about life insurance sounds about as fun as unclogging your shower drain, especially when it's not your hair, you're not alone. But staying on top of this stuff makes things easier on you and your loved ones. So welcome to adulting. Now, so much confusion when it comes to being an adult, like whether toilet paper is a better deal when you buy 6 double rolls or 12 regular. But the good news is that life insurance doesn't have to be complicated or confusing. By the end of this video, you'll feel confident about at least 3 things: what term life insurance is, what whole life insurance is, and why one of them is a bad idea. But before we dive into the details, let's start with the reason you buy life insurance in the first place. It has one job and one job only: to replace your income if you die. That's it. It's there to provide financial peace of mind for your family if the unthinkable happens. And if anyone in your life depends on your income, like your spouse or your kids, then you need life insurance, like yesterday. But not just any old life insurance, the right life insurance. And there's 2 main types out there: term and whole. So to understand the differences between them, it helps to know how they work. Let's go to the board. So, term life insurance gives you coverage for a specific amount of time, or term. Clever name, I know. So if you buy a $250,000 term policy for a 20-year term and you die within those 20 years, the people you named in your policy get a check for $250,000. You tracking with me? Now, picture a sharply dressed, handsome, relatively fit guy in his 30s. Let's call him, George. He wants a $250,000 policy for 20 years. It would cost him around $13 per month for that policy. That's about the cost of a gluten-free pepperoni pizza, and that includes the annoying $3 upcharge for the gluten-free crust. Now, whole life insurance is a type of coverage that, you guessed it, lasts for your whole life. And it costs a whole lot more because it's designed to also build cash value, which means it tries to double up as an investment account and life insurance. Now, if making investments with a life insurance agent sounds like a bad idea, that's because it is. Remember George, that sharply dressed young man in his 30s who, at most, looks like he's in his late 20s? Well, he meets with a whole life insurance agent who pitches a $250,000 policy. But because it's whole life, not term, this policy will cost him $260 per month. Now, that is $247 more than he'd pay for term life, which equals about 19 gluten-free pizzas a month. That's a lot of pizza. Now, you might be thinking, whole life is only more expensive than term because part of the premium goes into an investment account, right? Wrong. $15 goes to your insurance premium. The extra $245 a month disappears into commissions and expenses for the first 3 years. That is the worst magic trick I've ever heard of. And even after that, the cash value portion offers an insanely low rate of return for these investments. We're talking 1 to 3% here. So let's say George gets the whole life policy investment account. Well, after 20 years of getting a 2% return rate, his investment will be worth around a measly $72,000. Womp womp. Now, after 40 years, George is now 70. Still handsome and fashionable as ever, I might add, and he has $250,000 in insurance and roughly $180,000 in cash value. Womp womp. But then George dies. Rest in power, homie. But here's the worst part. The insurance company only pays out $250,000 to his family. But wait, what happened to the $180,000 of George's hard-earned savings? The insurance company keeps it. Sound like a ripoff? That's because it is. You see, only George is allowed to use the money in his investment account. So to keep it out of the insurance company's pockets, he would have had to withdraw and spend it while he was still alive. Talk about an expensive gamble. So what if instead, George gets the $13 a month term life policy and invests the other $247 he saves each month by not choosing the whole life plan? What could that turn into? Well, let's see. If he invests that money in a good growth stock mutual fund that has an average rate of return of 11%, he would have $214,000 in investments by the time that 20-year expires. Check that out. Now, let's fast forward. At 70 years old, he would have more than $2.1 million. Now we're talking. Now George has plenty of money for his family to live on without relying on life insurance. Okay, I know that was a lot. You just earned a gold star in adulting for paying attention to this, which I know you'd rather have a nap or an Advil. So let's recap here. Whole life is a whole lot of crap. It tries to do two things at once, insurance and investing, and it does a bad job at both. Term life, on the other hand, is affordable, flexible, and helps you build real wealth. Look, all this death stuff is not easy to think about. I get it. But the cost of not having a plan in place for your family's financial future is way higher than the cost of term life insurance. So if you don't already have term life, I recommend working with our Ramsey trusted provider, Zander Insurance, to help you find the right fit. They take care of me and my family, and I know they'll take care of you. Don't let another day go by without being protected.